Fears of a slowdown in the economy hitting stocks lately and making the Fed's road ahead all that more unclear. Today's tariff announcements only adding to that uncertainty. For more, let's bring in the former Dallas Fed president, Richard Fisher. Always good to have you, especially when we're trying to, make sense of all this. Let me just ask you from a fundamental standpoint. Do monetary policy people think of tariffs as a tax?
Well, I'm going to refer to our president's favorite reference, which is common sense. And common sense tells you that it is a cost factor that goes into producing or distributing a product. In that way, it is a tax. And what business operators, big or small, have to figure out is how do they protect their margins against that impact? And how much are they willing to change the price of their product or their service if it's applied in order to make sure they maintain their margins over time. So in that sense, yes, it is a cost factor, and I would consider it a tax. And then the question is, of course, how much revenue would be raised by this, particularly if it slows down the economy, Scott. And that is one of the other risks that the Fed has to face, which is it gives you a little inflationary bump. The question is how long it takes to be digested. I would argue that it takes time because businesses don't just change something overnight. They see what their customers are willing to bear. And then the only way to offset the threat to margins on the cost side is to ramp up your productivity, which isn't done overnight either. So it has both a slowing effect on decision-making, which could lead to a slower economy, as Goldman Sachs and others have come out today to talk about. At the same time, it increases prices in particular areas, especially now that Canada, for example, is retaliating not just on electricity. You have to realize they provide potash, which is the key ingredient for our corn farmers. And now the Chinese have said, in retaliation, they're going to go after all our farm products. And Scott, I'm a Texan. You can't live here without guacamole. And the most upsetting to me is the avocado. Was likely to have the imported avocados from Mexico.
Well, I think it's fair to say it's hard to live most anywhere without guacamole every now and then. So I'm with you on that. Let me ask you this. The New York Fed president, John Williams, says that he sees a very high pass-through of tariffs to consumers. You talked about, sort of what's at play and what's at stake. That would seemingly put the Fed at this very moment in a pretty difficult position.
Well, first of all, I have high respect for John. He's one of the smarter people I ever served with, and he's very thoughtful in his analysis. It's a question of what's likely to ensue here. You would make a decision based on one move. Again, we are told that President Trump is a negotiator. He has some objectives here. We'll see if he does what he did before, maybe not levy them at the same degree, maybe pull back on some, or maybe add more. So it's a little bit too early, Scott, to really get a sense of how the Fed might react. The Fed is bringing inflation down. We're getting closer to the 2% target. But at the same time, as I mentioned earlier, tariffs increase the cost of doing business, and that has to be passed on. Then the question is, how much does it slow down the economy? And I think we have to wait and see. This may be a clever strategy on behalf of the president. We're just going to have to wait and see, and it won't be digested overnight. It'll be passed through. The question is over what time frame and what kind of reaction consumers, but importantly, the people that distribute products, services, goods, what kind of reaction they pursue and how long it takes to be digested. That's what I would be looking at if I were still a member of the FOMC.
But do you think that it's prudent for your former colleagues, some of whom are still there, some are not, that they should start rethinking longer-running inflation expectations, just given what the agenda from this administration seems to be? And it is, as I described to a prior guest today, a new world order. They want to bring more manufacturing of critical products back to this country, which theoretically would lead to more inflation, right? Wages would be higher here than they are elsewhere. Is the Fed currently thinking about that? And if not, should they be?
I'm sure they are. I think they should. And they're going to have to consider in their economic models, whether it's the big economic model of the U.S. economy called Tariffs, or just in terms of listening, as they do very carefully, particularly through the 12 bank presidents, to what they're hearing in their local districts. I had all of Texas, part of New Mexico, and part of Louisiana. I listened very carefully to what people were telling me. And that's how we got ahead of the curve on the housing crisis in 08 and 09. So it doesn't always appear in your model, Scott. You have to listen carefully and then build that into your thinking, into your models. And it'll take time for them to model this out because we're not certain exactly what the president's going to do. And uncertainty is the enemy of decision making, as you know, and every business operator knows. So what I'm seeing, Scott, is people are holding back, trying to figure out what the heck's going on. And, I hope the president is successful here. But common sense tells me it's going to have an inflationary impact. And it's also going to lead to some slowdown unless we can figure out a way to harness very quickly AI, et cetera, to enhance productivity. And if we do, that's going to hurt the employment numbers as well.